what I'm now going to do is bring in our special guest for this week, Richard Aston, to talk about CC Japan Income and Growth and their sort of Japanese income strategy. You can see on the screen, we just got a little bit of blurb about Richard. He has sort of more than 20 years experience in managing Japanese equities. He doesn't just manage the CC Japan Income and Growth Trust, he also runs the CC Japan Income Growth Fund, which is an Irish UCITS fund. Richard began his career as an investment analyst with Sun Life Asset Management and was appointed as portfolio manager on the Japanese desk in '97. In 2000, he was appointed head of Japanese equities at Chase Asset Management in London, and then obviously became part of the JP Morgan sort of Japanese asset management team following the merger with JPM. Richard joined Cooper & Cardiff in 2010, where he's been running their Japanese strategies ever since. Hi, Richard.
Hi, Matthew. Thanks very much.
Just flick forward to your slide. So, would you be kind enough just to give us, sort of 5-minute introduction to the fund for those that perhaps haven't come across it before?
Yes, great. Thank you very much for the opportunity to do that. Yeah, around about 2010, 2011, when I moved back from Japan, we felt we had the opportunity to launch an investment strategy for Japan or for Japanese equities that was much more relevant for the way that the market had evolved, the way the economy had evolved, and for the valuations that we were seeing at the time, rather than many of the strategies that we felt were much more prevalent at the time, that were focused on either deep value or growth, or extreme levels of growth, which had been much more relevant in prior years in Japan. It's really a strategy we identified from the bottom-up analysis that we're undertaking individual companies and how they were allocating their cash flow, and in an increasing number of cases at the time, giving greater attention to their shareholders. So maybe if you just look at the first slide of the presentation, I think it shows really from a top-down level what it is we were beginning to see. The chart on the left-hand side is sort of aggregate cash flow from the corporate sector. That's the yellow line, and there is a blue line there, which is cash flow spent or CapEx. Mm-hmm. And there was this extended period, really through the economic miracle of the Japanese economy post-war through to the late 80s, where companies were spending everything that they generated, reinvesting all of that. That extended even through the lost decade of the 90s. And it wasn't until really after the Asian crisis and the tech crash at the beginning of this century that we feel Japan really finally began to address the problems that had been created by this period of overinvestment. And you can see that there's a very notable change there because the two lines diverge. Mm-hmm. And that was very much reflective of a change of corporate management, a response to some of the challenges that were now being faced by companies. So at that time, around about 98 to 2000, we saw nationalization of the banking sector. We saw bankruptcies of quite a number of major of leading companies in industries that were almost unheard of, life assurance, construction, securities, etc. And as a result of that, sort of corporate mindset changed. And the use of that cash flow was very, very interesting because first and foremost, companies were required to pay down all of the impaired assets that had been accumulated in the years before. Companies started to pay down levels of excess debt, and that process has really continued even to today. Japanese companies, or many of them, have been deleveraging consistently. Mm-hmm. Now for a long period of time. But also you can see, if you look at the chart on the right hand side, a portion of that now surplus cash flow started to come back to shareholders in the form of dividends and share buybacks in a way that it hadn't done before. That is of what was of particular interest to us, something that we noted. However, if we go back to sort of pre-Lehman crisis, the valuation of Japanese equities always appeared to be at a premium to global markets. And it wasn't until that period of 2010 onwards that we were able, for the first time, I think, to say that Japan had finally lost its premium, finally derated from the bubble valuations. Yeah. And was offering some interesting valuations because for the first time in my investment career, I was able to find companies listed in Japan who had valuations that were comparable, if not cheaper, to the international peer group. We launched the strategy at the beginning of 2013, and that was very fortuitous because former Prime Minister Abe announced a very major restructuring or a number of initiatives really to reignite the Japanese economy shortly after that. And in the third arrow, there was a very definite emphasis on the corporate sector and how they were to improve capital efficiency, improve their corporate governance. And a consequence of that, I think, has been this steady improvement in shareholder return. And that's really the focus of this strategy, total shareholder return, of which dividends are an increasing component.
Excellent. I mean, between the sort of two, I mean, how much do you think comes from sort of income, and how much would you expect from sort of capital growth over the long term?
And that's a good question. I mean, we have a chart that is showing actually the contribution from dividends is increasing. Obviously, that's been boosted, I suppose, by general weakness in equity markets over the last year. But we do see there are certain characteristics in Japan, maybe as an economy, certainly in terms of the equity market, that are very similar to the UK. And if you look at the UK, the contribution from dividends is very, very significant, and we expect Japan to continue to move in that direction.
Yeah. I mean, how easy is it to find income in Japan? You don't think of it as sort of being a high yield market, as you point out.
Yeah, I think, I think if you look back historically, that's been entirely the right view to have. Companies have not really paid attention to their shareholders in the way that investors in other markets are more familiar. But really, things are changing, and we are finding an increasing number of companies that are willing to reward their shareholders on a consistent basis. And the particular attraction, I think, of Japan is that there are an increasing number of companies really that are in that very, very strong position. So one of the attributes that we see of Japan as a whole, and certainly to individual companies, is very, very healthy balance sheets. That's a consequence maybe of the historical track record that I've mentioned, companies paying down debts now for over 20 years in aggregate. And also the fact that up until maybe sort of 10 years ago, there wasn't really a shareholder focus, an understanding of the requirements of shareholders. So many companies were just accumulating assets on their balance sheets, liquid assets, and now those are flowing back to shareholders. So finding companies with attractive yields is becoming easier as time goes on, because the strength, the financial strength of the companies is very evident. And we're finding more and more companies whose management are sort of willing to accept the role of shareholders.
I suppose in that regard, obviously there's been big changes in sort of recent years to the corporate governance code in Japan, which has obviously praised or put much more emphasis on shareholder returns. I mean, do you think that's made a big difference to your universe?
It has, definitely, yes. I mean, that was one of the initiatives that was brought under the Abenomics umbrella. Improvement in stewardship code initially, so that's the forcing a relationship with sort of domestic pension funds and domestic asset managers with companies, requiring them really to ask the sort of questions that I think international investors ask companies. And then that was followed by the corporate governance code, which has created this new environment. The combination of the two, really, the stewardship code and the corporate governance code, have created this new environment in which shareholders and corporate management can communicate in a way that they weren't before.
Okay, that makes sense. And we've got a question from the audience here. It says, how are company valuations in Japan looking today compared to other markets? I mean, is there sort of still a problem whereby you can sort of look at Japanese equities and you try and compare them with other markets, and they're distorted because of higher cash levels on the balance sheet? And if so, how do you take account of that?
Yeah, I mean, if you look at sort of headline valuations, I think Japan arguably looks cheap on some measures. Obviously, price to book is one that people look at, and that's a tangible book. Those are real assets on the whole. If we look at it in terms of earnings, I think Japan stands up very well, given the cyclical component of the earnings as well. Obviously, we're focused specifically Well, yeah, I mean, the main focus of our investment approach really is to focus on companies that have a very, very attractive sort of shareholder return valuation, and by that we take into account the return to shareholders through dividends and to some extent share buybacks, and also consider sort of the growth potential. And I think it's really sort of the combination of the the current yield that you're able to sort of generate off Japanese equities, combined with the growth prospects for that income, that really make it very, very attractive.
Yeah. Yeah. Okay.